Mastercard is one of the world's largest financial companies, yet it doesn't lend money. It doesn't hold your savings, it doesn't approve your mortgage, and it doesn't give you a loan at the checkout counter. So how can a company that never lends a dollar become worth billions? The answer is hiding in plain sight. Mastercard doesn't make money by owning money. It makes money by moving it. And once you understand that, the entire modern payment system starts to look very different. Because most people think of Mastercard as a bank. It looks like a bank. It sits on your wallet like a bank card. It even feels like a bank when a payment goes through in seconds. But Mastercard says it is not a financial institution. That is the key misunderstanding. A bank takes deposits, issues credit, manages risk, and often lends money directly to consumers. Mastercard does none of that. It is the network in the middle, the set of rails, rules, and standards that lets one bank talk to another bank instantly and reliably. That simple difference changes everything. When you tap or swipe a Mastercard, you are not sending money straight to the merchant. You are starting a chain reaction. First, you buy something from a merchant. The merchant's acquiring bank, sometimes called the acquirer, receives the payment request. Then that bank sends the transaction into Mastercard's network. Mastercard routes the message to the bank that issued your card, the issuing bank. That issuer checks whether you have enough funds, whether the purchase looks suspicious, and whether the account is open. Then it sends back a yes or no. All of that can happen in seconds. If the answer is yes, the network doesn't stop there. Mastercard also helps the system clear and settle the transaction, making sure the money ultimately moves from the issuing bank to the acquiring bank through the financial plumbing behind the scenes. That is why the whole system works at global scale. A card issued by one bank can be used at a merchant served by another bank, in another city, or even another continent. Mastercard's real product is interoperability. It makes a fragmented banking world behave like one connected payment system. And here is the part that makes the business so powerful. Mastercard does not earn interest from cardholders. It does not profit because you carry a balance. It earns from fees tied to the movement of payments. Think of it like a toll road for commerce. Every transaction sends a small charge through the network. Mastercard also earns from cross-border activity, where payments move between countries and currencies, and from value-added services built on top of the rails, like fraud tools, analytics, and security services. In 2025, Mastercard reported total net revenue of $32.791 billion, with $19.476 billion from its payment network and $13.315 billion from value-added services and solutions. That is a business built on flow, not lending. And the scale is staggering. In 2025, Mastercard reported $10.6 trillion in gross dollar volume and 175.5 billion switched transactions. Think about that for a second. If you can earn a tiny amount from each transaction, tiny suddenly becomes enormous. Mastercard also reported more than 3.3 billion cards in circulation across consumer credit, consumer debit and prepaid, and commercial cards. That means the network is not some niche payments processor. It is embedded in everyday life, from coffee purchases to airline tickets to business travel to online shopping across borders. Cross-border payments are especially important. Mastercard says it switches substantially all cross-border transactions, and that makes international commerce one of its biggest advantages. When people travel, shop globally, or pay a foreign merchant online, Mastercard can often sit at the center of that transaction. In 2025, cross-border volume grew 15% on a local currency basis. That matters because cross-border payments are usually more complex, more valuable, and more profitable than ordinary domestic transactions. The more the world trades with itself, the more important Mastercard becomes. But Mastercard's power is not just about volume, it is also about competition. Visa runs almost the same model, which is why these two companies are often compared like twins locked in a permanent race. Neither one is a bank, neither one lends money. Both depend on banks, merchants, and consumers using their networks. In the United States, Visa still has the larger share of purchase volume, but Mastercard remains a giant. The real battle is not for headlines. It is for network reach, issuer relationships, merchant acceptance, and the priceless habit of being the card people trust without thinking. That battle is expensive. Mastercard reported $20.522 billion in rebates and incentives in 2025, which is basically the price of winning and keeping major relationships inside the network. In payments, scale does not just create strength, it creates leverage. The bigger the network, the more valuable it becomes to banks and merchants. And the more valuable it becomes, the harder it is for rivals to replace it. That is why Mastercard and Visa can look like simple card brands on the surface, while underneath, they are running one of the most competitive infrastructure businesses in the world. Still, the future is changing fast. The next fight is not only about where you can pay, it is about how invisible the payment becomes. Mastercard is pushing toward tokenization, biometric authentication, and numberless credentials, with a goal of phasing out manual card number and password entry by 2030. In other words, the company wants checkout to feel seamless enough that the card itself almost disappears. The best payment is the one you barely notice. But there is also a threat from outside the card world. Fast payment systems like Pix in Brazil and UPI in India are proving that countries can build powerful alternative rails that move money quickly and cheaply without traditional card networks at the center. Brazil's central bank said Pix was the fastest growing payment instrument in 2024, with transaction volume up 52%. That is a reminder that Mastercard does not control the future of payments, it competes for it. And regulation, court cases, and pressure over fees can reshape the economics of the whole industry in a hurry. So why has Mastercard become such a powerful company? Because it does not need to lend you money to profit from your spending. It sits in the middle of global commerce, charging for access, speed, trust, and scale. It turns every card tap into a tiny piece of revenue, then multiplies that across billions of transactions, billions of cards, and a planet full of merchants and banks that need to talk to each other instantly. Mastercard became enormous by becoming invisible. And in the modern economy, that may be the most powerful position of all. If you enjoyed this, subscribe for more business stories.